Welcome to The Explainer. This is where we break down complex source material into clear visual presentations. Today, we're going to walk through a really unique geometric market analysis. So let's jump right in.
So what we're doing here is documenting a method from a group called Market DNA, and we're going to see exactly how they've applied it to the S&P 500 index.
Now, this analysis, it uses a proprietary system. It's all based on these predefined geometric shapes. We're just going to follow the documentation, step by step, to see how it all unfolds in a real-world scenario. We'll be focusing on the documented sequence for one specific cycle, which is labeled SP500_2_2. And it's really important to know we're going to stick strictly to what's visible in the events and the data provided in the source material. No more, no less.
Okay, let's get started. The process kicks off with what the documentation calls Phase 1, and this was all recorded on February 1st, 2026. So, what did that initial setup actually look like? In this first image from the source docs, you can see the price has hit what they call level M. This point is designated as the primary entry point for this whole cycle.
Looking at the plan, it actually lays out two different potential entry levels. You've got the primary one at M and then a secondary one at PC. The plan also projects a 25-day duration for this shape they call the trapezoid.
Next up, let's talk about the risk parameters. Now, these are all based on a hypothetical scenario that's laid out right in the source documentation for us. So for this scenario, they start with a hypothetical capital base of $100,000. This number is really the foundation for all the risk calculations that come next. And here's a key constraint they've set. The maximum allowed drawdown on this capital is 5%. That means from its highest point, the total loss can't go beyond that 5% mark. Now, this is where we really get into the nuts and bolts of their risk model. We have several key variables here, like the 30th triangle domain and the risk coefficient. According to the documentation, these are the exact inputs they use to figure out the position size.
So when you take those parameters and plug them into their formula, you get a calculated trade size of 0.79 for each of those two potential entries we talked about.
And the source material is incredibly specific about how they get this number. It states directly, and I'm quoting here, both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. It really shows how systematic the approach is meant to be.
The plan also gives us three potential price targets, and each one is defined by a very specific point within this geometric structure. You have target 1, target 2 at something called apex N, and finally target 3 at the very top of the trapezoid.
So based on those targets, two different profit scenarios are projected. And the main difference between them? Well, it all comes down to whether that secondary entry point, PC, ever actually gets triggered or not.
Okay, and here's where the documented timeline takes a really interesting turn. The very next event that's recorded isn't Phase 2, which you might expect. It's actually labeled as Phase 3.
So get this. On February 2nd, the day right after Phase 1 was initiated, the price reached what they call apex N. The documentation shows this happened at the 6,937 level.
So, the crucial takeaway here is that the documented sequence shows Phase 3 completing before the conditions for Phase 2 were ever met. This really drives home the point that these phase numbers are just labels, not necessarily a chronological 1, 2, 3, 4 order.
Okay, so with Phase 3 in the books, the next event in the log is actually Phase 2. Let's take a look at what that involved. Later on that very same day, February 2nd, the chart shows the price reaching up and touching the mirrored delay line. The point of contact is documented right at the 6,997 level.
You know, this timeline really helps clarify that unusual sequence of events. Phase 1 kicks everything off on February 1st. Then, on the 2nd, Phase 3 is completed in the morning, and that's followed by Phase 2 completing later in the evening.
So, all of that brings us to the current status of this documented cycle. According to the source material, this cycle is still considered open, and that leads to one final question. The source documentation kind of leaves us hanging with this open question. After this really interesting sequence of Phase 1, then 3, then 2, it asks, will the next phase be Phase 4? And as people just observing this record, well, that's where the documentation currently leaves us.
Before we wrap up, it is absolutely essential that we cover the disclaimers from the source material. Please remember that this is not financial advice. Leverage above 10 is prohibited, and you should not invest essential personal funds. This analysis is purely for public documentation, and any risk management must strictly follow the instructions provided. Thanks for joining us for this explainer.